This is not financial nor professional advice. This video is for entertainment only. Hey everyone, the market is getting very hairy and maybe scary since the Fed and Jerome Powell announced that, oops, we did it again. I did it again. We didn't do what we were supposed to do in the past because we wanted to delay the inevitable. And so we're going to spring this on you and hope that the market doesn't crash too bad. Well, let's look at some of the strategies or inverse and contra funds that I would use to counter this surprise behavior. And the behavior is getting a little less predictable and more changeable with this Fed than I'm used to from the Fed in the past. But I think they're in unusual circumstances with this flu, and I think that's what they're coping with, and that's what they're trying to work around. They're trying to reduce inflation and trying to avoid crashing the market too badly.
So just chill out. Drink a 7-Up, eat a moon pie, quit murdering people.
I want to emphasize that this strategy is not for the faint of heart, and it's probably preferable that you have some experience with shorting, or if you do start out, that you start out in a minor way and kind of work out how it works for you. Some people are naturally good at this, others it's not your thing, and it's usually not my thing, but I can pull it off on a selected basis for short periods of time is what I've found. So this is not financial advice, and this is simply what I'm doing. It may work for you, it might not work for you, but this is simply what I'm doing, and I'm not trying to give financial advice. So what I do is I select a fund that is most likely to be overvalued in an overvalued area. Usually it's an index fund of some type, and it's things that I think are overhyped, that have just blown up too fast, too quick, for too long, and now actually need the shorting process to help it reach a level of bottoming so that it can go forward. Actually, what we're going through now is a market downturn that's been avoided and avoided because the Fed would not let it go down. To a fault, they did this. And it's not been good. The S&P from its recent highs is down 2%. That is like nothing compared to the gains it's made. So I look at things like the S&P Biotechnology Index, and that's one that could be shorted. Now, when they're developing a drug, they have sometimes no income because they're in the process of developing it, especially if they're a new company. And so they're borrowing money, and so interest rates going up will be a serious drag on these companies, and they're the most likely to go down. Okay, and so this is simply placing a bet on increasing interest rates affecting this index the most. Okay, I don't enjoy doing this. Again, it's a short-term thing, and my hope is that it's a quick crash, hopefully, or at least not longer than a couple weeks. That's my hope, that it goes down quickly, that I get near the bottom. I never try to get the exact bottom, and I never try to get the exact top. I try to be near it. and that's usually the best you can hope for. And so there's danger in trying to play it too close. Okay, once you've made enough money, to satisfy your objective, and that's why I flooded with a lot of money for a short period of time, because this is something that I'm hoping for a sharp crash, and that actually as I short it, what you do is they borrow you a stock, but then you have to buy it back later, and these funds do that for you, okay? And so you actually are helping it off, you're helping to establish a bottom, and then once it bottoms, you help it to go forward because you have to buy that stock back. So it's and people and indexes and stocks, they get into what's called a short squeeze, and that's where the demand for it turns suddenly from it going down to people all of a sudden seeing that, hey, this is a bargain, and they start to buy it, and then these funds have to cover their shorts because they're being squeezed. Well, you want to get out when you feel just a little squishy, okay? You don't. The main thing is not to get smashed, okay? Once it gets a little squishy, you want to get out of there, okay? In the name of the inverse biotechnology fund that I just described, that I'm planning to short, probably, is the Direxion, that's Direxion, daily S&P Biotechnology ETF. Its symbol is LABD. So LABD, LABD. Now this inverse fund, this LABD, is triple leveraged. So for every dollar that this biotechnology fund goes down, you make $3. Okay. Now you also want to remember that it works the opposite way too. For every dollar that this fund goes up, you lose $3. So the emphasis is on getting out before it starts going up. Another one that I would consider is the Direxion Small Cap Bear. Again, this is a triple leverage fund. I like the triple leverage short funds on things like this because, again, I'm flooding the fund with a lot of money for me. And it's a lot of money for a short period of time. I need the triple leverage to get in and out. So I only have to be right for a short period of time if I do this correctly. So it's the Direxion, Direxion, small cap bear, and its sign is TZA, T zebra A. So I hesitate a little bit on this because you would think the small cap funds are already beaten down so badly, but I will imagine that most of you have never really been through that severe of a market crash. That was quick. I remember 1987 stock, and this was a short, quick crash, where it went down 25% in one day. Okay, now the crash we went through in 2020, that was relatively short and relatively quick, but I almost don't count it because it was so clear to see that it was going to happen. I got out of it before it ever. The one in '87, you didn't see it coming. At least I I don't think many people saw that one coming. It just came out of nowhere, struck like lightning, and it was gone fairly quickly. But the one in 2020, that was so clear that was going to happen that I think a lot of people avoided it, like me. So I don't consider myself unique in any respect. I think that was obvious. In my mind, I almost don't even count it, But I notice in major crashes, and I'm thinking more of the dot-com crash in the early 2000s. The market crashed and kept crashing for a long time and took down the real estate market. That was the worst crash in so many ways in my mind. And so that's what I'm thinking of as a really bad crash that you don't want to see happen. And no matter how far small caps have fallen, they will fall worse than the large caps. and it's people cling to the big caps in a market crash, and they give up on those stocks last. I want to thank you for watching this video. Be sure to like and subscribe so that you receive notifications of future videos, and I will plan to see you in the future.